the specific cost of that product to do a specific identification problem. Now we're going to go into first in, first out using the same given information, same purchases. Alright, let's go through A. March 1st, 10 units at $100, $1,000 total, that's our inventory balance. March 13th, 15 units, $110, $1,650, our ending balance is $2,650. Now, March 14th, we sold 20 life vests with a per unit selling price of $220. Okay, first in, first out. How are we going to calculate the cost of that? We've got 25 units on hand, and each of those has a different cost. 10 units were at 100, 15 units were 110. How do we apply the cost? All right, first in, first out. The first one in is the first one out. 10 units go out at $100. That gets rid of that first line on that March purchase. Okay. Now we sell. Okay, so that gets rid of that bucket. Now we sell 10 at $110. That gets rid of that bucket. So the total cost of that sale is $2,100. Our ending inventory balance is $550. All right. Now March 17th, we purchase inventory 20 units at $120. That's $2,400. March 28th, we purchased 10 units at $127. That's $1,270. Our current inventory balance as of March 28th is $4,220. Now, March 31st comes. Round Belly sold 23 life vests with a per unit selling price of $230. All right, that's the selling price. What's the cost? First in, first out. We go back. We still have 5 units up in this tranche. We bought 15 here, but we sold 10 in the previous transaction. There's still 5. We got to get rid of those 5. 5 at 110 go out. That's $550. Subtract that from our ending inventory balance, and then we sold 23, so we need 18 more. This bucket here on March 17th, we bought 20, so we're going to take 18 out of there. That cost was 120. That cost of goods sold for that 18 times 120 is 2,160. Our ending inventory balance is 1,510. Our cost of goods sold, $4,810. All right, that's the sum of this column. It's carried over here. That's FIFO. All right. Now let's move into LIFO. Last and first step. All right. Same activity. Now we're going to calculate costs using LIFO. March 1st, we purchased 10 units, $100 per unit, $1,000. March 3rd, 15 units, $110, $1,650. Our inventory balance as of March 3rd is $2,650. March 14th, we sell 20 life vests with a per unit cost of $220. All right, that's the selling price. What's the cost? Last and first out. The last inventory that was in is this bucket right here, 15 units at 110. Get rid of those 15 units at 110 right here. Subtract them out of the inventory, put them in cost of goods sold. Now we have 5 left. Go to our previous bucket, 10 at 100. Calculate that 5 out of that. 5 times 100 is 1,500. Our ending inventory balance as of March 14th is $500. All right. March 17th, we purchased 20 units at 120, 2,400 in. March 28th, we purchased 10 more units at 127, 1,270. That inventory is in. Our current inventory, or the balance of inventory March 28th, is 4,170. So you see that's different. The March 28th balance of inventory in the FIFO was 4,220, and now under LIFO it's 4,170. All right, LIFO March 31st, we sell 23 life vests with a per unit selling price of $230. All right, that's the selling price. What's the cost? LIFO, last in, first out. So we go back. We still have 10 units left from this. 5 units left from our purchase at $100. 5 units at $100. Get rid of those. Oh wait, I'm reading this wrong. Go back. All right. LIFO, March 31st. We sold 23 life vests with a per unit selling price of $230. That's the selling price. What's the cost? All right, the cost. We still have last in. We just bought 10 units at 127. Get rid of those. That was the last one in. 10 units at 127. That's 1270 out. Now we go back to the other most recent purchase on March 17th. We got 20 in there. Get rid of the remaining 13 from that bucket. 13 times 120. That's 1560. Get rid of those. Our ending inventory balance is 1340. Our cost of sales is 4,980. and we'll do the comparison at the end, but this is drastically different from the FIFO method. All right, now getting to the weighted average cost. Same inventory activity, weighted average cost. March 1st, we purchased 10 units at 100. That's 1,000. That's our inventory balance. March 13th, 15 units at 110, 1,650. Our new balance is 2,650. March 14th, we sell 20 life vests with a per unit selling price of $220. That's the selling price. What's the cost? We need to do a weighted average calculation. Take here is the calculation. So, cost of goods available for sale. The total cost of goods available for sale as of March 13th is the same as our ending balance as of March 3rd. That's 2,650. We have a total of 25 units on hand. Divide 2,650 by 25. That'll get you an average per unit cost of 106. 106 times the 20 units we sold. That gives us our cost. Cost of that sale is 2,120. Our ending inventory balance is 530 as of March 14th. All right. Now we purchase more inventory. March 17th, 20 units in at 120. That's $2,400. Put that in inventory. March 28th, we purchased another 10 units at 127. That's $1,270. Add that to inventory. Our inventory balance as of March 28th, $4,200. All right, March 31st, we make a sale. We sell 23 units at $230 per unit. That's the selling price. What's the cost? The cost, weighted average calculation. Go back to March 28th. That's our current inventory balance on hand. The cost right there is $4,200. How many units do we have after the March 31st? How many units do we have divided by the 4,200? It's going to be 5, 20, and 10. 5, 20, 10, that's 35. Divide the 420 by 35. Comes up with a per unit cost of 120. 23 units out at 120, that's 2,760. Our ending inventory balance as of March 31st is 1,440. Now, let's go to the middle of the cheat sheet. You'll have a chart comparing each of the methods, the ending inventory balance versus the cost of sales, and how that affects net income. All right. So specific identification, we saw total sales. Total sales amount is the same for each, right? We sold the inventory, or we created a sale. The sales price was the same, but how we costed the inventory was different. So you look at cost of goods sold, specific ID 4,831 versus FIFO 4,810 versus LIFO 4,980 versus weighted average 4,880. All right. So what was our gross profit after that? You know, the lower the cost of goods sold, the higher the gross profit. FIFO had a higher gross profit. LIFO had a lower gross profit. Remember, because the most recent purchases went out first. The most recent purchases were more expensive. Well, on FIFO, the last purchases went out first. Those last purchases were cheaper, so our cost of goods sold is less, right? So that means our profit's more on FIFO, but we're paying more tax on FIFO. If you look down at the bottom, income tax on FIFO, we're paying more because our profit's more. LIFO, we're paying less tax because our cost of sales is higher. You know, revenues minus expenses. You take that times your interest rate or your tax rate, you come up with your tax expense. Tax is higher on LIFO, and so then our balance in ending inventory balance is lower in LIFO, is higher in FIFO. So basically, that's the comparison. As you can see, the advantages of each method. Weighted averages smooths the cost, right? That one's like right in the middle of all these. First in, first out. Ending inventory approximates current replacement cost. The ending inventory is higher because our recent purchases were higher. Ending inventory approximates our replacement cost. LIFO better matches current costs and cost of goods sold with revenues. Remember, okay, the last one in was the first one out. That hits cost of goods sold. Our cost of goods sold is higher. That better matches the current cost, right? So we're putting cost of goods sold higher. That better matches the current market value of those inventory. All right. So basically, all that happens within inventory. Now, I went through that fast. There's a lot to digest. There's a lot of material. Go through it again. I guarantee you're going to see this information on an exam, your homework. You're doing all these calculations, specific ID, first in, first out, LIFO, weighted average. You're going to have to do these in your financial accounting class. I guarantee it. Now, look up here in some ratios. Similar to the common financial ratios for accounts receivable. I'm not going to go through the inventory ones. I'm just going to tell you, like, conceptually what they mean and what we want it to look like, what's better, what's worse. All right, inventory turnover, cost of goods sold over average inventory, same thing. You know, the higher that one, the better. That means our inventory is churning over faster and faster. You know, we're getting rid of stuff. We're making sales. We're buying inventory, making sale. Buy inventory, make sale. The higher that turnover, the better. That means we're making more money. All right. You know, days inventory in. So days inventory on hand. That, the higher that is, the worse. We don't want inventory on hand for a while, because that means we're not making sales. That means we're buying inventory and it's just sitting there. We're not getting cash for it. It's just sitting there. Days on hand, we want lower. We want that inventory turning. Okay, that's inventory costing.